Most UK parents are completely missing out on an extra £9,000 of annual tax-free allowance. They assume their own £20,000 ISA limit is the absolute ceiling for protecting their wealth from the taxman. But by ignoring the junior ISA, or JISA, they are accidentally leaving a massive fortune on the table. If you only look at your own investment accounts, you are playing the game with one hand tied behind your back. The real secret to building generational wealth isn't just maximizing your own portfolio. It is about running a parallel portfolio for your children that can compound completely untouched for up to 18 years. What most people do not realize is that the compounding math on an 18-year horizon is almost magical. If you stack £9,000 a year into a JISA from birth, you are not just saving money. You are building an absolute fortress of capital that can completely alter your child's financial future before they even take their first full-time job. But you cannot get there by leaving that money in a standard high street bank account collecting a miserable bit of interest. To maximize this long-term window, you need a highly intentional mix of heavy-hitting equities, rock-solid index funds, and smart fixed-income assets. Before you skip ahead to picking individual shares, you need to understand the structural rules that make this vehicle so insanely powerful. The unique mechanics of the junior ISA are exactly what make it a compounding superpower. When you invest through a standard account, you are constantly fighting the friction of dividend taxes and capital gains. Inside a JISA, every single penny of profit is shielded from HMRC completely and permanently. The ultimate catch, and the thing that scares many parents away, is that the money belongs strictly to the child. They cannot touch it, and crucially, you cannot take it back out until the day they turn 18. This absolute lockup period is actually your greatest psychological advantage as an investor. Warren Buffett famously said that the stock market is a device for transferring money from the impatient to the patient. A JISA literally forces 18 years of pure, uninterrupted patience onto your strategy. You are structurally forbidden from panic selling during a market crash, which means your capital has no choice but to sit there and grow. The surprising part comes next, because picking the wrong assets inside this long-term lockup can completely ruin the entire strategy. When you have a timeline spanning nearly 2 decades, your greatest risk is not short-term market volatility. Your absolute greatest enemy is inflation, quietly eating away at the purchasing power of your cash. That is why a massive chunk of a long-term child portfolio should be anchored in broad market equity index funds. The ultimate foundation for this is an all-world exchange-traded fund, like the Vanguard ETF. This single asset instantly spreads your child's capital across more than 3,600 companies. It gives them direct exposure to the massive growth of giants like Microsoft, Apple, and Nvidia, while hedging against the decline of any single economy. Warren Buffett has consistently advised that for most people, the best thing to do is buy a low-cost index fund. By holding a global equity ETF, you are betting on human ingenuity and global economic progress over the next 20 years. If you want a slightly cheaper alternative that focuses heavily on the world's largest market, the iShares Core S&P 500 UCITS ETF is another phenomenal anchor. It tracks the 500 largest American companies with an incredibly low management fee of just 0.07%. Hit that subscribe button right now if you want to keep mastering these exact kinds of high-impact wealth-building strategies. If you want to start building this portfolio today, you can join Freetrade and open a JISA account using my link below, and we will both get a free share to kickstart the journey. While index funds give you a safe and reliable average market return, you can use a small portion of the JISA to target exceptional compounders. These are individual, high-quality global stocks that possess what Warren Buffett calls an impenetrable economic moat. You want businesses with pricing power, immense cash flows, and products that the world will undeniably still need 2 decades from now. Think about a company like Alphabet, which owns Google and YouTube, essentially controlling the front door of the entire internet. Think about Berkshire Hathaway itself, which operates as a massive, diversified conglomerate designed specifically to weather any economic storm. You could also look at a dominant luxury powerhouse like LVMH, or a consumer staple giant like Diageo, which owns massive global brands that people buy regardless of a recession. What most people do not know is that you do not need to trade these stocks or check their prices every week. You simply buy them, turn on the dividend reinvestment plan, and let the corporate profits automatically buy more shares month after month. But equities are only one side of the coin, and the second half of this strategy involves a massive structural shift happening in the bond markets right now. To balance out the aggressive nature of stocks, you should look at high-yield fixed income assets, which are currently offering the best entry points in years. For a UK-based investor, British government bonds, known as Gilts, have become an absolute gold mine for predictable wealth generation. Right now, 10-year UK Gilts are yielding up to 4.7%. That means you can lock in a completely guaranteed, predictable return backed by the British government for a huge chunk of your child's upbringing. If you want to avoid buying individual bonds, you can easily use an index fund like the Vanguard UK Gilt UCITS ETF. This gives you an optimized basket of British government debt that pays regular income directly back into the JISA. If you want to diversify outside the UK, you can look at US Treasuries through the sterling hedged ETF, which lets you capture American government yields without worrying about currency fluctuations. The beauty of adding these assets right now is that as interest rates begin to normalize globally, these high-yielding bonds provide a robust cushion. They ensure that even if the stock market goes through a wild 10-year cycle, a portion of your child's wealth is mathematically guaranteed to compound. The true magic happens when you combine all of these pieces into a simple, automated asset allocation model. For a child under the age of 5, you have the luxury of time, meaning you can comfortably allocate 80% to global equity ETFs and individual Moats stocks, leaving 20% in high-yield Gilts. As the child approaches their teenage years and gets closer to that 18-year finish line, you can slowly tilt the scale. You can gradually shift the balance toward 50% equities and 50% bonds to lock in the gains and protect the final lump sum from a sudden market downturn right before they get access. If you execute this plan consistently, you are not just handing your child a random pot of money on their 18th birthday. You are handing them a masterclass in portfolio construction and a massive financial launchpad. Make sure to watch our next video breaking down the exact index funds to use for your own adult ISA, and keep a close eye out for our upcoming market update on how today's shifting gilt yields will impact your portfolio tomorrow.